This is Kulbhushan from Marcellus. Thanks a lot for your time today evening. While the title on the screen gives me a little bit of jitters that okay, you are affluent but still anxious. And I remember not long ago, maybe when I had all the black hairs on my head, making money was considered a little bit of a hesitation that okay, I want to make money. And this is, I'm speaking maybe from my father's generation when it was only a government job which we all used to desire. And then private sector opened up. And then let's say the famous IT boom happened. People started making money, and a lot of us included, myself included, sitting in a tier three city in India, used to think that whoever has made money must be pretty happy. There should not be any concerns. Things are fine. And of course, over the period of time, we all went into our own occupations and made a certain amount of money. Some time back, when we started interacting with our investors on a one-on-one basis, this I'm referring maybe last 18 months or so, what we could see is that these are the guys who are, let's say, our PMS investors. So they should have a certain amount of purpose or wealth in life. And still there was some bit of disconnect, some bit of anxiousness, anxiety that things are not all right. One part in few cases which we could see, and we discussed that with Manish sometime last year, August, September, was that disproportionate asset allocation has happened, and that might be one reason. But then Manish decided to take it head on, and he said that let me go into detail and try and understand what's happening there. And that's what this study is all about. I've said Manish a couple of times. So Manish is the one of the co-founders at Marcellus and COO also. And let's understand it from Manish. What's the insights which Marcellus and Dun Bradstreet survey has given us, and what do we think about it? Are there any outcomes? Are there any call to action for people who are listening, people who are looking at this survey, reading about this? Manish, over to you. Please take us through this.
Great. Thank you, KB, for setting the context for today's conversation. Good evening, everyone. Thank you for taking time on this Friday evening. As KB mentioned, the idea for today is actually for us to sort of go a bit of a deep dive into the study that we did, which we call it Marcellus India Wealth Survey, that we did in earlier this year. Now that we didn't go with the title in mind, that's what we will find, but these are the outcomes in a way. Those three words pretty much summarize what we saw. And what we will do in today's session is to bit of a deep dive and see the patterns, what's happening, what are people thinking, and how does it what does it mean for us, and if at all we can do something about it, what can we do? There's lots we can do, so we have that as well. So we'll essentially look into those bits. So let me kick start. Right. So I've actually I thought I'll lay out again. KV pointed out why we did the survey, but this is actually the pertinent question that came. I distinctly remember this conversation I had with Mr. Tanna. The names disguised, the informations are the same, but obviously for protection reasons, we have changed the name. Right. So he was a 48-year-old professional. Now at that point was living in Bangalore with wife and two daughters. The daughters were in the middle years and were going to the Ivy school. He previously had worked and lived in the USA and Hong Kong. He essentially worked in one of the Magnificent Sevens for some time. And as part of it, he got paid off pretty well in terms of ESOP. So when we looked at it, his total investments were of around 12 CR. And he has built a house in India while he was settled in the US. Right. And the point of conversation, the aspirations were to retire at 55 and, send the daughters for, international pursuits. So again, very, very modest sort of, I would say, goals, so long as, the aspirations are confirmed. But at the same time, when we had this conversation, and again, the reason this came to the fore because Mr. Tanna had invested with us, but in one of the review conversations that we were having with him, obviously, he had questions around, the markets are changing, this whole jitters coming around. What does it really mean for me? So to understand the context better, we deep dive into the objectives and the needs of why Mr. Tanna has invested overall, and then with us. And in the process, we uncovered his journey, and again the destination, essentially the objectives that he wanted to sort of pursue. But what really stuck with me was what I've highlighted here is in red, right? So Mr. Tanna, and he actually put it in a very philosophical way. He said, Manisha, I always thought I worked really hard. I have moved 4 countries. I've got the best education I could get. I worked in the places which reward really well the growth sectors, but I'm never really sure if I'm financially sorted, right? And if you can help me understand that, that'll be that'll be really useful, because I always think I am sorted, but I'm never sure, and that's the sort of anxiety remains with me. And when we found the insights from the survey, that anxiety was the word that sort of stuck with me, right? So here we have Mr. Tanna, a very decorated career. 12 years of investments, again, a very pretty healthy balance sheet, but still not sure in terms of whether he has enough. So this was again joins in, but these are the sort of patterns in terms of the outcome or the need that we were looking for from our investors when we were doing their portfolio and the reviews. And then we thought, let us, because there's a pattern emerging, let us go deeper and understand what actually is happening at a wider scale. And this is when we commissioned this survey. It's what we called India Wealth Survey. We did this in collaboration with Dun Bradstreet. They were our study partners. And we structured it essentially around the affluents and HNIs. So we didn't restrict ourselves to HNIs only. We essentially went around that as well. So we scoped the survey around the participants around from the age of 30 to 75 years, right? And we stratified the whole study so that we get responses from across the country and across demographics. So we looked at across age bands. Then again, we went to metros, mini metros, tier 1 and 2 cities, so that we have representation from geographically as well. We again stratified for salaried individuals as well as business owners. And the threshold we put on the income was 50 lakhs of income, net of taxes, household income of 50 lakhs or over for metros, and at least 20 lakhs for non-metros, right? So with these stratifications, we got the study commission with Dun Bradstreet. This was done in the Feb and March of this year, pretty much at the end of the record-breaking bull run we had over the last 5 years. And we got around 465 responses. Now, these were very difficult to get because we are only looking at top 3% of the affluent Indians. And the responses we got were all the way from in total investment size of a couple of CRs to double and triple digit numbers. So it's a fairly wide study. There's a representation across board. And let's look into what did we find, right? So the first thing we looked at was India's wealthy are rightfully, they have high life aspirations, right? But the study helps us quantify that. So 40% of the responders wish to retire early. When I say early, this is before the age of 60, which we typically think as a standard retirement age. So 40% had aspirations to essentially stop working for the obligation of paycheck before 60 and then pursue something of their own. And the 40% of these wanted to buy a house of their own, so they don't own the house at that point, but one of the goals was to buy a house that they live in. 40% wanted to start a business. I believe some of these were those who wanted to retire early to start a business, but 40%, which is a pretty punchy number, wanted to start their own enterprise. And 3 in 4, given the segment that we looked at, 3 in 4 had some or the other goal with regards to higher education for their children or getting them married, right? And as you see, these sum up to more than 100 because we had asked for multiple goals, and we did find the Indian wealthies have multiple aspirations, and they are pretty punchy when we talk about, right? But on the flip side, we also one of the questions we asked was if they have any concerns at all about achieving these aspirations, and there were clearly outlined concerns, and we had again there were a lot of options there. So the first thing that really popped out was the low investment returns. Like 40%, 4 in 10 essentially cited low investment returns that they're getting from their existing investments as the key concern, which they believe will stop them from achieving the returns. Now, this surprised us actually quite a bit because we just finished, or we were, we just saw the end of the remarkable bull run over the last 5 years, where equities, essentially anybody and everybody could have made money specifically within equities and other investments as well. So, but despite the bull run, the primary reason for concern, the concern was low investment returns. What else did we find? We found 3 in 10, they put lack of savings discipline as the concern. They believe they're not able to save enough. 21% cited poor understanding of investment options, right? So here we are talking about the wealthy Indians, right? And I'm sure they are catered by multiple financial advisors, wealth managers, relationship managers who advise them on what do they need to invest in. But despite that 2 in 10, which is startling for this subset, the specific set we are talking about, said they don't really understand all the investment options available to them. Right, and another startling number was 9% citing high debt burden that they are sort of carrying, right? So which they believe will slow them down. So in terms of concerns, again, fair bit of concern, multiple concerns, starting with returns to debt. So fair bit of sort of color into this. Moving forward, we sort of looked at their asset allocation, right? So we asked folks to essentially select what proportion of their overall investments are invested into which asset class, and this excludes the primary residence they live in, because house is not a goal, it's more of a need, a necessary, so we don't look at it as an investment. But the question here is, we asked what we are showing here you essentially is what proportion of the responders had more than 20% allocation in each of these asset classes that we have: real estate, debt, equity, and jewelry. And the way to read this chart essentially is 51%, which is roughly half of the responders, had 20% or more allocation into real estate, right? And the same applies for debt, equity, and jewelry. When we go to debt investments, which are essentially PPF, fixed deposits, fixed income instruments, 4 in 10 had more than 20% allocation to into debt or fixed income investments. Equity came a third. Roughly a third of respondents had more than 20% or more allocation to real estate. And then 15% called jewelry and other assets as part of their overall asset allocation, right? So, I mean, it's a pretty straight trend, but real estate continues to dominate the asset allocation of Indian wealthy. That's what we see. In a way, the previous concern that we saw of low investment returns tells you, right, equity allocation at an overall level, what we saw from the sample we saw, which is again is a very, stratified sample. 1 in 3 have, exposure to or a substantial allocation to equities, right? And the bull run just finished. So if you didn't have exposure to equity, you pretty much didn't see the returns that the rest of the market or what you see in the charts sort of played out. So it's a pretty useful insight. We thought the equity would actually come, but actually equity comes at a third place when you look at the overall asset allocation of Indian affluents when you look at. Moving on. So while the asset allocation is something we looked at, what we also saw is there are some sort of struggle with saving discipline and debt obligations. Now, 2 of these were reported themselves by the respondents. So where they said the key concern they believe is lack of saving and the debt that they are carrying. When we went from the other dimension, from the other questions, when you look at, one startling observation was 14%, right? 14% of affluent Indians, which includes HNIs and UHNIs at some point, 14% of the respondents don't maintain any structured emergency fund. Right. Here we are talking about a very healthy income, healthy balance sheet at the back of it, but no ring-fenced emergency funds in place to deal with any emergencies, which was if there was one surprise in the whole survey, this was the biggest one for me. Right. And when we look at the lack of saving discipline, 43%, 4 in 10 claim they save less than 20% of the net household income that they take. And 4 in 10 have a loan. Now, loan can be understood because a lot of real estate, obviously, housing loan is the dominant category here, and it helps you build assets as well. But at the same time, it's come with it should be manageable. And an element of is what we saw is the concern on the previous question. So while loan is good and you do need it, you need to be mindful of that's a double-edged sword. But that's what we are observing. I think the lack of emergency fund was clearly the highlight for me from when I looked at the insights. Moving on, so we asked question on what do they need help on? What do they need guidance on? And some questions around their comfort with various asset classes. One finding was 3 in 10 don't feel very comfortable investing in equities. And again, let's look at who are we looking at here. We are looking at the most affluent Indians, and 3 in 10 still not very comfortable investing into equities. So I believe this number is moving as we speak, as the participation goes up in the market, but still a fair bit of way to cover, at least in terms of confidence. From a global diversification, when you talk about 21% have begun to diversify globally, so they have some investments into global markets. And 23% said it's not just they're not even aware of whether they should diversify globally, or if they should, then how to go about it. So these were the key outcomes in terms of if they need any help with with their investments or their asset allocation, what it is. So still a way to go in terms of building comfort with equities and the diversification or awareness of that. Yeah. So the next question we asked them essentially is about along with the help on diversification and so on. What is it that they're truly looking at, right? And the question essentially was if the professional financial planning will help them achieve their goals, move forward, help them answer their concerns, and so on. So overwhelmingly, 80% said they believe that professional financial planning can put them in a much stronger position towards achieving their goals. So clearly, there is a fair bit of awareness in terms of approaching it in a planned way, and that's what essentially the respondents also asked for. And on the right-hand side, when you see, we asked them what help or assistance do they expect from this trusted advisor, from this financial planner. And 32% called out that they need help in planning major life events. Right, as Mr. Tanna at the outset when we saw, he wanted to send daughters for international post-graduation and also wanted to retire early. But it was still very big. It was a life aspiration. What folks are asking, like Mr. Tanna, is how do we plan these events? 38% asked for more personalization approach to their goals, more personalization approach for their investments, which is based on their goals and their risk, right? So they don't want a one fit all sort of a solution. They want this advisor, financial planner to essentially look at their own unique needs, unique goals, and help them with how should they allocate their investments across asset classes, or in what fashion should they structure their portfolios. So that it's aligned to their own unique goals and not just a standard sort of a one-size-fits-all approach, right? And 8% called out for that they want conflict-free, transparent advice from their advisor, which essentially means that they want the investment decisions to be in favor of them rather than of the intermediary or the advisor. So that this was clearly the call from the advice that they expect in terms of professional financial planning. Right. So these are some of the key highlights. I thought I'll just call out here in terms of what we found. There is much more. This was a deeper study. We asked a lot of questions, and then we have some cuts as well. So these are available on the website. I thought I can take you through the whole survey, but that will be a very deeper exercise. So we thought at least at this session we'll cover the big highlights. But there's the detailed insights are available on our website. If you can just land onto the home page, there's an icon on the right hand side. You just have to click that. It's called Marcellus India Wealth Survey, and that will take you to much more deeper insights if you wish to sort of go through. Okay, so I thought in the next section we will look at. So while we look at the study that we did, right? What can we do? I'm sure when you looked at these insights and maybe Mr. Tanna's case, we find some of us might have the similar questions in terms of are we there? Are we financially sorted? Is our financial future secured? Can we retire early if we plan to? And those questions. So I thought I'll put some sort of framework here for us to see what can we do, you and me do to move forward from here. So the first step in this process, this is what we also do with all our investors, whether existing investors, we do them with this every time we review, or prospective investors who come. We start with their needs rather than what should they do, right? And the first step in this process essentially is around financial planning. Is to plan, right? You need to know what are you planning for. And the cliche says failing to plan is planning to fail, right? So the idea essentially is, once you know, we all invest for a purpose, for a reason. The idea is to translate that reason, those goals, life events into clear and measurable financial goals, right? So can be emergency funds, can be education, can be weddings, can be gifts, legacy, house, international travel, philanthropy, buying a car, buying a vacation home, whatever that is, it is for you. Translate that into a clear, measurable financial goal, because then it becomes something that we can track and move forward, and we can back solve it and plan the investments around it. So that's the first step. Again, a few assumptions go into it. There has to be an inflation in place, because what a car worth is today can be substantially different in the future, because of the inflation. So we do have to assume inflation in certain other bits, but planning is the first part, right? The second is allocate. Once we plan our goals, we have to allocate our investments wisely, right? And they should be aligned to our unique goals and risks, rather than mood of the market or what's going around around us, right? And the table we just plotted out here to say, goals can be of multiple types. You can lump up all the goal into one and say, I can plan for all my goals together, but different goals need different orientation. If you are looking for emergency fund or emergency cushion as a goal, which is the fundamental goal, must be in everyone's plan when we talk about, right? You have to plan for emergencies. Which are the things that don't play out? Which are the things you haven't planned for? Right? The orientation for emergency fund has to be liquidity and instant access. You should be able to tap into these funds in minutes, right? You don't expect them to compound at 50% odd, but the idea essentially for this is to be available as and when you need. And the allocation that potentially you would think for emergency cushion is low risk debt, stuff like fixed deposits, where you're not risking, you're not taking any market risk, you're not expecting high returns, but they are easily accessible whenever you need them. Right. Again, the part of the goal planning, what you find is some goals are short term, some goals are long term. So short term, anything in the next 3 to 5 years can be a short term goal. And that has to be thought through differently from a long-term goal, which is say 15 years away, right? And the reason is, in the short term, any investment we make, any asset class we invest in, will be volatile and will be prone to market risks. So anything in the short term, the objective should be to avoid or to protect them from the market risk and inflation. Inflation is an invisible risk. It's all around us. We don't really look at it like that, but the value erodes 5-7% every year. So the idea for the short-term goal is to guard them from the market risk and not to protect it from volatility. And here, fixed income allocation could make sense, where it's not growing drastically up or down, but it's compensating for the inflation, right? And the long-term goal, as I said, something that's 15 years away, we have to optimize it for risk and returns. Risk and returns go hand in hand. High risk, high return comes in. So to essentially to the comfort of each of us, how comfortable are we with the risk. That's what we need to optimize for. And the allocation could be a diversified, risk-adjusted allocation across various asset classes. Right. So usually we lump all the goals into one, but based on the time horizon of when the goal matures, based on the risk appetite of the investor, how comfortable, what makes you sleep easy, right? And again, the need, different goals need to be looked at differently and should have different asset allocation. So that's when I say allocate your investments wisely, that's what I'm talking about. Right. The third piece on this is diversify. So again, diversify thoughtfully across uncorrelated asset classes. So the third allocate, on the previous slide, I talked about the long-term goals, which are years away. When you plan for them, because we have to invest into multiple asset classes, the idea is to actually invest in multiple asset classes and do not double down or concentrate on a single asset class. So as we saw, real estate used to be and even still is in the previous slide we saw, dominates the overall asset allocation for a lot of folks. But we want to diversify. Diversification reduces risk. But when you diversify thoughtfully, especially across uncorrelated asset classes, it can actually reduce risk without compromising returns. Right. So what on the screen I have put in is an indicative sort of an allocation for a certain risk profile. Now we have 4 asset classes at the top. So we have debt and income, fixed income. We have gold, global equities, and Indian equities. Debt is not correlated to any of the other three. All the other three assets are related to actively to the markets. Fixed income essentially gives you fixed income unless you're trading bonds, which can have mark-to-market correction. Right, gold and equities, generally speaking, are uncorrelated or rather inversely correlated. When equities do well, gold sort of goes for an easy run. But in volatile markets, as we are seeing in the last 6 months, gold has done fantastic. And when we talk about equities, and for most of us, for long-term goals, portfolios will be asset allocation will be equity oriented because that's where most of the returns come from. Most of the risk comes from there as well. So we should have some diversification, a lot of diversification within equities as well. Now it can come in many shape and forms. One is geography. So here, when I say global and Indian, we are calling out say developed markets and developing markets diversification. So a small proportion of an overall asset allocation could go to developed markets like US, UK, because they will have their own economies which are not really coupled or correlated with Indian economies. And equities do, behaves in a similar fashion. They have high risk, high return profile across various economies. So global equities could be one aspect of diversification. And chunk of it will be in Indian because we understand India really well. But again, that needs to be diversified further into say large and small mid caps, small caps. So you can do it by cap size, you can do it by value of style of investing, be it value, growth. But essentially all put together, this says the whole pie needs to be sliced into smaller chunks. Because again, you all would have heard this, right? Asset classes perform differently in different market cycles. So rather than predicting what the market cycle is going to be and where should I be, this helps you prepare for any market cycle. So that's part of the portfolio continues to perform. So diversification is pretty central to any long-term portfolio when we think of, right? So you've done the allocation, you've done the diversification. Now comes two key aspects, which are not to do much with the investments, and it's not a rocket science, but more to do how we behave, right? So the first one is remaining disciplined and sticking to the plan. So you have done the hard work of planning, allocating, and diversifying. Now let the rest of be now remain disciplined on the other bits as well, right? So first point is lifestyle inflation. Runs much faster than the monetary inflation. So the inflation we usually talk and hear about is the 6-7% odd CI numbers published, right? But the lifestyle inflation or the lifestyle creep, whatever way you call it, runs much faster and it's actually much faster. Yeah, so need to be mindful of that and be very wary of if you're getting into a lifestyle creep, because that will move your time value for money very drastically. Right. The second point is kind of an extension of the first point. Don't let the occasional luxuries become perceived needs. Right. So if you remember, we take a couple of vacations and we book 5-star rooms, for example. Nobody wants to then downgrade again and go to a 4-star or 3-star. Right. We start with a couple of international vacations and in few good years, then we don't really feel like an Indian vacation will sort of do the job, especially kids. Right. I think once you get a taste of luxury, it's very difficult to step down. But again, be mindful of occasional luxuries, which are important, right, and deserving, but they should remain occasional if that's the case, right? Avoiding debt for instant gratification. So debt is a double-edged sword. It helps you build assets, especially when you talk about the home that you live in, right? But to use debt for consumption assets or instant gratification can be detrimental, because it can take your cash flows away from your investments, and it can take your asset allocation, can create misallocation into that. So again, be mindful of that. And the last one is simple discipline. You just review regularly. We should review regularly our goals, our cash flows, the allocation that we plan for, the investments that we plan for, and an asset allocation, if remains untouched, can go out of shape because in an equity bull run, equity will grow out of proportion. So if the equity is supposed to be say 60% of your portfolio, at the end of a 3-year bull run, it will become 70. It needs to be tamed down back to 60. That's called rebalancing, but it's part of that. So again, rebalancing regularly helps you remain disciplined, but one should still review their goals and cash flows on a regular basis, right? And this is the last one, again, a pretty important one, right? We need to keep emotions in check. If you have done the planning, if you have done the asset allocation in a wise, informed fashion, which is aligned to your goals, if you have diversified, you've done pretty much everything that's one supposed to do, right? But what happens is we are surrounded by noise, cacophony all the time, right? And we are emotional human beings, so we feel we need to react to everything that's happening around us, or some news has come in. Trump has said something these days. The Israel war again restarting. What should I do? What should I not do? So every reaction around us, can create an impulse for us to react on. So if you've done the first three bits, most of it is done. We just have to keep emotions in check. Don't react to everything that you hear. Another thing is popular fads, right? So this sector, that this or that, whatever is the latest fad in the market, it's popular for the world, but it may or may not be optimal for you. So don't really have to chase every fad that goes around you. Just do an assessment whether this new opportunity or the avenue that has opened up, does it really optimize things for you, or is it detrimental, right? And don't let fear or greed or impulse drive your decisions. A lot of what happens around is a noise which self-correct itself. I mean, we can look at what happened in COVID. Was a really testing time for all of us. When you look at the Sensex curve, it goes sharply down, comes back up, and the compounding continues, right? So greed and fear or impulse decisions are the key drivers that break the compounding engine, which is the eighth wonder of the world. So don't let that get in way. And the last one, as I said before, instead of predicting what's going to happen in the market, just prepare for it. And if you do the first three things, plan for yourself, do the allocation, align with your goals, align with the plan, and diversify, you are pretty much prepared for any outcome the market makes, right? And so there's no point going on predictions, because nobody can do it. I mean, you can get lucky a few times, but it's very difficult to do it on a sustained basis. So the best way is to prepare for the market and not predict for it. Again, a cliche, but it makes a lot of sense, right? Just one thing I want to call out: all of this is simple. There's no rocket science here. What we did, goal planning is time value for money. You take today's expenses, you inflate them by the inflation, you discount them by rate of return, and it tells you how much you need today, right? Again, not reacting, not doing, not giving into emotions is all. It's all there. It's all simple. What I've said is nothing really rocket science, but it's not easy, and it's not easy because once we do all of this, we go back to our jobs, and work comes in the way, life comes in the way, we get busy, we get distracted, right? Emotions, however much we say we are emotional beings, we are surrounded by a lot of dynamic stuff around us, and we tend to pay attention to it and give into it. Discipline falters. We can keep an SIP, but an extreme market, market cycle, when the small caps sort of falter, and should you stop your SIP? Should you continue? So again, the remaining disciplined also becomes a challenge. Analysis paralysis, right? We do, and the two ways this really comes out is what fund should I buy, and what stock should I buy, or how do I time it? Is it the right time? Is it will there be a better time to buy tomorrow, or should I sell out? And we get into this analysis paralysis, and we are not able to make decisions, right? So all of this is simple, but in real life, it's not easy. And the only thing I want to call out here is do it yourself. DIY is do it yourself. Do it yourself if you can, right? If you can do the 5 steps that we mentioned, and not let these things come in a way. But if you can't, don't hesitate in taking services of a professional financial advisor who can do this for you, because that's their job. They are not emotionally invested into this. They are professionals. This is their day job, and they can do it dispassionately for you without emotions coming in the way. So by all means, this is simple. You can do it yourself. Nothing stops you apart from the bits that I mentioned. But if you can't, there's no harm in taking services of a financial advisor that you trust, who is aligned with your interests and can help you make the right decisions, can keep full transparency, can personalize your plan for you and your decisions for you. That's the crux of it. That's what we saw from the as an outcome from the wealth survey. So and any advisor should do right, so long as they are aligned with your interests. So that's all I had on the second part, which essentially said how should we look at the survey and how can we make use of what we've learned from what's going on in the financial lives of Indians. Now, when you talk about Marcellus, so again, we obviously saw the pattern within the existing client base, in multitudes of conversations that KB himself would have done hundreds of these, and I've done around 100 of those. But we clearly saw there was a gap, and investors were coming to us, and entrusting us with an allocation, but when we looked at the whole 360-degree view of their investments, at review, we realized they had disproportionate allocation to equities in general and Marcellus in particular. Or, there were other things that were out of shape. And most importantly, they were chasing returns rather than chasing their goals. So once we started a sort of goal-based approach where we started asking, what are you investing for? Things became much more clear for all of us, and the investors are able to take much more informed decisions. So this has become practice of what we offer. So we offer no-cost goal asset allocation exercise, right? So you can plan your goals within few minutes and see how do you stand today, where do you stand today, this is what you have. We have access to diversified portfolios as well, right? So fitting into the different, we don't have everything, but we have portfolios which can fit into certain aspects of the asset allocation. And then the ongoing counseling support throughout the investing journey is something as part of what we do. Again, KB does it as a full-time job. That's what he does day in, day out. So that's where we can, again, you don't really need us for this. Any trusted advisor who is aligned with your interest, who, and does this specifically for you, not a one size fit approach should do this. But in case you need us, we are around you. And this is the tool. So when I talked about, how can you plan your goals? So this is, we created a small utility. It does the time value for money. Again, nothing rocket science. I talked about it, but if you punch in some information, it can tell you where do you stand in terms of achieving your goal. So basis what you have today, what percentage of your goals are funded, and beyond that, it can also give you some insights on asset allocation. So again, there's no cost. It's a free utility. There's no obligation to invest with us either. In case you use you check your goals and you want to have a conversation, there's no cost or an obligation to do this with us. Yeah, that's all I have. Thank you for listening to me to my monologue, and I'll take a pause and give it back to you if there are any questions we can answer or anything we can elaborate on.
Thanks, Manish. Thanks for taking us through this. Participants, if you have any queries, please type them in Q&A box, and Manish and I will be happy to take that. Manish, for the large part of the second part of your presentation, you were sounding like my doctor. And while I like the guy, I don't want the medicines which he prescribes to me. They are good for me, but then, so are these two things sort of alike? We all want to be healthy. We know how to be healthy, but then behavior is where we all are caught up.
Yeah. So I mean, there are different ways to call it. None of this is rocket science. I think all of us read a lot about it, and this is building blocks of what we do, right? I mean, think of KB. I mean, another analogy that comes to me is if you're driving down to a distant location, right? Why do you need Google Maps? Right? In the old days, you used to have maps. Now you have Google Maps, right? So even if you know where you're going, you still now have a habit of putting a Google Map because it tells you where the traffic is and so on. So even if you can do what you can do, you still now trust on a trusted guide or a GPS navigator, right? And a lot of it is because of the behavior. So rightly put, we know what it is, and the medicine is there, but what really comes out on the way is the behavioral part. Because we get busy, and the biggest of it all is, I'll say, behavioral biases, right? So we anchor ourselves to recency is one of the most prominent bias, right? We look back what happened in the last bull run or last 5 years, which is a bull run, and we assume the future is going to repeat, right? What happened in the last 5 years will continue to happen. So that's one. Emotions, and within emotions, greed and fear, and more than greed is the fear, right? Because that makes us insecure. So these are the few things which manifest in multiple shapes and forms. The fear, anxiety, and fear. Anxiety is a low grade fear, right? So sort of fear. So these are the two root causes: the biases and the fear, which manifest into various behaviors, which essentially protects us from doing the right thing. But you are right. It sounds half philosophical, half doctoral, however you put it. But it boils down to the medicine, which we know we need to take, but we don't.
Better I start eating fruits and going for exercise. So let me start with the audience questions. Okay, let's start with this. So the first thing which a gentleman is asking is that I'm 30 and I earn sufficiently well. I'm doing SIPs for next 20 years. Why do I need asset allocation?
Yeah, no, good question. Great. I think to start with, starting regular SIPs at 30, that's one of the best things to start with. The sooner you start, the longer you have for your investments to compound, right? And compound interest really is the eighth wonder. It can do magic. So that's a good place to start. What one needs to, so for this gentleman specifically, I think SIPs is one, and you are accumulating and you have a long runway. The other checks you might want to do, or the gentleman might want to see is where are the SIPs going, right? So number one is a single asset class, equities. That's where we are investing the SIPs in, right? And if that's the only thing we do, we end up having a substantial concentration or an allocation to equities in general. Now, as I said, a portfolio for us, for growth-oriented portfolio, has to be equity-oriented. But there are roles of other asset classes to pay as well. Again, diversification. If you have a long period, I think between 6 and that twice has been where equities have actually done zero returns over a 7-year period, right? So 12 to 14. So if you get caught up in that part of that phase of the economy, even equity SIPs can actually maybe suboptimal. Again, I'll go back to the diversification bit. Orientation towards equity is great, but other asset classes have a role to play. They come really handy. They really add value over the long term. And the second is, even within SIPs, are they diversified, or is it going into the same sort of, if it's a small cap, is it all going into small caps, which can put the investor in a tricky position? So again, the selection in terms of, and less so with funds, but more so with, again, sectors and styles and so on. So is the gentleman diversifying enough within the SIPs? That's the second thing to check. So it's a right behavior, again, starting early and being disciplined about SIPs. But other things to check are whether, what about other asset classes, and within equities, is diversified enough or not?
Sure, noted. And I think one piece here also is that if, let's say, your investments are not aligned to your goals, what will happen is that today you are starting early, and that's a good thing. 5 years down the line, 7 years down the line, you would want to buy a house, and if you have not planned for it, the first thing you will look at is this area which you have gathered via SIPs, and here it goes. So
Yeah, so those are the basics, right? We forget the basics. What about emergency funds? Maybe that's the first question I would ask. You have
correct.
I hope you have
In fact,
emergency
regarding
funds.
emergency funds, there are a couple of questions, and the nature is two ways. One is that if, let's say, I'm doing well in life, I'm an affluent guy, why do I need emergency fund? And I'll club the other one also. That what exactly should be emergency fund? Should we keep it in bank account? Should we keep it in cash? Should we keep it in any equity arbitrage? How do we really deal with the emergency fund?
Yeah. So the answer to the first part of the question, right? If I have consistent cash flows, if I have healthy cash flows, why should I think of emergency funds, right? So I think Morgan Housel, I think in the book Psychology of Money, he's defined as risk is something that you have not planned for, right? Because if you have planned for it, you have mitigated the risk. You would have planned for it, right? So emergency fund, one should think of it like that, right? There are things that you don't know that can happen, right? It can be an extreme weather event. It can be an extreme event in the family. It can be an extreme event in your professional life, markets, right? When I say weather event, it could be, landslides. It can be anything at all. I'm
Correct.
going extreme here, but these are the things we usually don't think about. And this is where you need emergency funds, because you would not plan for it, right? Your cash flows can abruptly stop for an extreme event which is not in your control or not caused by you, right? And which is where, even for somebody with an irregular income, obviously you need to plan for longer. But even for somebody who has a regular cash flow income, emergency fund should be at least 6 months is what I usually call out. But at least 3 months, is a bare minimum one should do it. I'll say stick to at least 6 months. So yeah, you do need emergency fund for anything that you haven't thought of, because anything can. It's a probabilistic world we live in, right? So we don't know what can happen tomorrow. So that's the
I
first
agree.
one. The second one is where to put it, right? So see, bank accounts is a good way, but there you sort out for the so again, orientation. What do we want emergency funds to do? We want them to be readily accessible, and we want them to be liquid, right? Both at a moment's notice. If you need money in a couple of hours, you should do. Now, bank accounts solves for that, but bank accounts these days, the interest rates is pretty low. It essentially kills the whole inflation bit. Fixed deposits, I would believe, should be a good go-to place where you can park, and in case you need to liquidate the fixed deposit, you pay some sort of a breakage fee and access the funds. One can also consider debt mutual fund, but it also takes a couple of days to liquidate. There's a process involved. And again, what debt you are investing in, you are probably taking some sort of a risk. So my go-to place is fixed deposits to the primary bank that you work with, linked to your bank account if you can, so that you click of a button, the money is in your accounts, which you can utilize for whatever the need has come through.
Sure. And I think as far as the emergency fund piece is concerned, liquidity and capital protection should have equal measure, and they should be your two criteria.
Exactly.
Idea of it is easily accessible. So maybe a bank account does it. For some of our investors, when we were discussing this, they mentioned that we are judicious users of credit cards. Judicious is the keyword here. And maybe that will take care of the emergency thing, and I'll park my emergency funds in a equity arbitrage fund or a very, very low risk equity plan with 10-20% kind of an allocation. So different folks, different methods, but idea is it has to be there.
Yeah.
Or whether you're affluent or you're a lack of it, but that needs to be taken care of. Let's move on to the next set of questions, Manish here. So there are a couple of questions regarding real estate that typically we Indians have our sizable money in real estate. Your survey shows that. Why you have not included it in your diversification or investment sheet, which you have mentioned? And is there any way we can actually participate in real estate and make it a portfolio?
Yeah, it's a very pertinent question. Actually, I should have had it here. So real estate, right? So one thing to note, I'll actually call out that the house that you live in, it's a residential house that you occupy, that's more of a need than an investment. We do need a house. In a lot of cases, that also doesn't make sense, especially in Bombay, where, you can live on a yield of a 1.5%, especially if you take HRN into consideration, it can go lower. But let's assume that, we need a house or should own the house that we live in. So that when you do that, and that becomes in a way your indirect real estate. But let's exclude that. Even in the survey, we had asked for the question that the real estate that the people should allocate or give us the allocation for should exclude the residential house that they live in. Now, when talking about real estate as an investment, right, it can be commercial or residential, where you buy another property to let out. There are a couple of challenges with real estate, right? One is it's pretty lumpy. It's a very high ticket purchase when you do, which means if you go on to build an allocation in real estate, one, it takes a lot of it needs a lot of investment, right? And when you do that, it may dominate your portfolio or your overall asset allocation because it's one lumpy investment that you just made. Right, so that's one consideration. But generally speaking, more so from returns, right? Real estate, the one of the biggest disadvantage, or the one needs to be careful for, is the returns from real estate. Real estate operates in a very micro market. Every neighborhood is its own market. You can't compare, your neighborhood with the next neighborhood, because the value of your neighborhood in a house will be very different from that. Second, there's no ready market available for it. You can't just sell it the way you can go, market will give you a real about the value of an Asian Paints or an HDFC Bank stock, and you can just liquidate in a minute. Here, the market needs to be created, right? And the creation process defines the discovery of the value of your of what you're owning. So the valuation is a challenge. The growth rate is very erratic. Your neighborhood can go. Second, it's a very cyclical sort of sector, right? So real estate cycle goes on for a couple of years, then stagnates for seven odd years, then comes back. So that does work over long term. Fourth is it's inflexible. You can liquidate. You can sell if there's a need. You can liquidate a part of an equities portfolio, or part you look at a fixed deposit, but you can't sell one room of your house of investment house and say I want to realize the cash. So you have to do the whole thing, right? So it's inflexible. It's large, lumpy, illiquid. A lot of times it doesn't generate cash flows, right? And even if it does cash flows, the yields that come in after taxes and all, it's really puny. So a lot of capital appreciation happens, but that's not cash flow generation. It essentially remains within. That's one challenge. And for all these reasons, real estate can be an investment, right? But it needs to fit into your overall asset allocation. It's not I wouldn't call it as a core investment. The four that I listed are the core investments or other investments for a core investment portfolio. When I say core, these are the ones that once you figure out your aspirations and goals, this is where all they should go to. Real estate can be an add-on, but it can be part of your surplus, or if you have more money, if the value of your goals is say 3 CR, and if your core investment portfolio is 3 CR, that's fine. Anything more than 3 CR, you can invest in real estate. However, these days, as we see, the REITs, REITs, and in which they REITs specifically, they give you an option to take exposure to real estate as an asset class in a fragmented way, where you don't have to go through all the transaction costs and everything that we talked about. It's a very effective way to gain exposure to or take allocation into real estate as an asset class, and it's fungible, flexible, and so on and so forth. So that's the modern world. We are yet to catch up. The market is still being built as we talk about, but that's the way to build real estate in the financial form. The overall real estate, a property as a house, I wouldn't think of it as something if you have more than what you need for your goals. I wouldn't include it in the core asset class.
Sure. And there are a couple of questions regarding the global investing piece you mentioned.
Yeah.
The question is more like that you gave us a division of Indian equities.
Yeah.
How we should invest.
Yeah.
Can you give us some cues on how global equity investment should be done?
Yes. So again, the way we have taken the Indian equities slide, so I'm on that slide now. The way we have taken the Indian equities piece of pie, and cut it into multiple slices. Global also, it's a 12% allocation, which can be meaty. I think as it sort of grows, you can blend it with index funds and maybe some active funds as well. Index being the mature markets, the indexes are much more mature. For the US, you can say something different. The tech dominates the overall US index as we speak, right? But I think it's prudent to have some exposure to the overall index, because in the matured markets, and then add an active kicker to it, so that you are diversified at market level, and then you have some focused sort of investments which can drive a bit of return over and above the index. So even global equities, when you talk about, that should be the way. Now, having said that, if you have surpluses, or again, if you need what you need for your goals, and if you have more than that, there you can actively go and take more active funds and active positions, which you believe are the set of companies that maybe will grow faster, or the funds that will compound faster. So that's the way to look at it. Within the core portfolio, diversified, a blend of active and passive in terms of indexes. That's one way to go. But over and above, especially in opportunistic times, if you the surplus money can easily go to the active funds.
Okay. And one gentleman is checking on that how the bifurcation between large, mid, and small should be if somebody is of age 55, approximately 55.
Yeah. So
should it be age driven, or should it be is there any other way to look at it?
Yeah, that's a very, very pertinent question. So thanks for asking that. So one thing, age is one dimension, but the allocation to large, mid, and small needs to be actually based on the risk tolerance of every investor, right? And the reason I'm calling it risk tolerance, because everyone has their own ability to live with the volatility that we see day in, day out, right? Again, theoretically speaking, small caps will beat large caps and mid caps over a 10-15 year period. We all know that for a fact, right? But we live with this every day in, day out, and that's where the behavior comes in play, right? So age, certainly I will peg this too, but more than age, even the risk tolerance, right? For an investor who is not really comfortable with the volatility, let's call them a balanced investor, right? Should have a relatively smaller allocation to small caps compared to an aggressive investor who can stomach volatility and be and sleep easy, still sleep easy. So sleeping easy is should be something, should be at the center of when you look at your asset allocation. Coming to the age, I think if the gentleman still have a runway of 10 odd years to sort of move forward, to sort of retire and, not consuming from this, small cap can have that allocation. But this is the piece where rather than guiding what it should be, a lot of it is based on the specifics. So this is a standard allocation and indication of what I've called out. So please don't take this as an investment advice or the go-to allocation. Your own allocation has to be really tailored to your goals, your risk, and when your goals are gonna mature. So when I talked about small cap, it has to vary between risk profiles, right? But the right way to do this essentially is to do the whole personalized planning and allocation, and an outcome of that would be what you do. And at the right time, you may want to sort of juggle between these as well. But again, that's a tactical allocation that an advisor can help with. So I don't know whether if I answered the question, but generally speaking, an aggressive allocation will have a higher small cap, should have a higher allocation to small caps. compared to balanced. But asking for a specific goal or for a specific individual, this needs to be personalized to them based on how their own comfort with the risk and their own set of goals and current investments.
Sure. I think understanding one's risk appetite is extremely important because uh, we all overestimate it. That's what I think we had another discussion with many investors over a period of time. What we could see clearly is that most of the time it is overestimated. I can take risk. I am an equity guy. I can be 70% in small caps, but small caps do correct 30, 40, 50, 60, 70%.
Exactly.
That's not everybody's cup of tea. So a measured approach, of course, is needed. Manish will stick to this sheet because there are a couple of more questions coming on global equities. So you gave us an overview of it. How do we invest? How can one invest in global equities? That's one question. The other question is do you have a product which can cover a flow for global equities?
Yeah. So, Kibi, why don't you answer this question? I think there are different ways to do global. So we have Indian funds and offshore, but do you want to take this up?
Sure. So, two pieces. See, one part is the easiest way, and wherein there's no amount restriction, also comes via mutual funds, wherein it can be taken. There are funds specifically investing in global equities, US, Europe, some of the emerging markets. And there are some funds which invest only a part in it, right? So, ideally, when you can make a choice about it, which way you want to go. The other way is to open a demat account, which any of the brokers who deal in international equities and buy it. That's akin to you buying Indian equities on your own. So if that's a very specialized job, you need a particular skill set for that. Please be very sure about it. The third way is, let's say, Gift City is giving us options wherein which we can invest abroad. We have a product called Global Compounders, which fits in, but then that comes with a higher ticket size. So it's not a one size fit for all approach, depending upon your particular risk appetite, whether you are fit for it, whether that much amount can be afforded to it, will all depend. But yes, we have a product called Global Compounders. It's completed around 2.5 years in existence. Has been good performer. That can fit in that's one way of doing it.
So talking about our product, so I think Global enables you to do the LRS and essentially invest directly. But even the multi-asset portfolio that we do, right, which essentially takes the allocation that you see here and converts into an actively managed portfolio. Within that, when we do equities, we do it through fund of funds or the global funds, which go and invest offshore. Now there are restrictions there, so in terms of the availability. So, but we when we do it within the multi-asset domestic portfolio, that's how we go on to take. And if you wish to do so, you can do that as well. Overseas, it's through the Gift City and the LRS, which opens up more options. There's no limits to that. Your LRS quantum is your limit, but how you do, there are various ways to do IBK account, as KB you mentioned, and
Sure. I think MF side, you just need to check on because there is an overall industry level
yes,
limit,
that's
which
correct.
industry hit in
Yeah.
2022. Because of that, different funds keep opening at different points in time. That's something which you have to take care of. Moving to one more question which has come up on the small cap side only. So, what do you prefer? A small cap actively managed scheme or a small cap ETF? Will that actually make a difference if I have both in my portfolio?
Yeah, so my view and what we see is, I mean, when we talk about active versus an index in small cap space, so generally speaking, half the active funds, we know are not able to beat the benchmark, but things are slightly different in small cap because in small caps there is a value of an active management over and above the index when you sort of talk about, especially in the extreme events. Right, and again, because it's actively managed, it will vary from the index. Again, the best way here would be to blend the two, have some passive exposure to the small caps through an index, and then top it up with an active manager, because active management does add value in the small cap space, which is much more, the information is still not all that. It's relatively more inefficient than the large cap. When you talk about index, I think large cap index with the mutual fund again into large caps, you will see a smaller deviation. But in small caps, we do see there are deviations between index performance and active performance. But that's my view. KB, what do you and what has been your observation?
So you are right when you say that a lot of small cap mutual funds fail to meet the respective benchmarks, and that's also a function because each fund undergoes different cycles basis what is their investment style, what is the quantum of diversification they wish to do, are they heavy on a particular sector, sunrise sector, and so on and so forth. So multiple things, but from a small cap, large cap perspective, and I think this is what we do at times in the multi-asset portfolio also. That it's not that you invest in a small cap and you forget about it. If in 2020 calendar year I start with a 20% allocation to small caps and let it be, am I done because I did my asset allocation in 2020? I need 20% allocation in small caps, and I did that. 5 years later, without my doing anything, this 20% has ballooned up to 28%. So that is where it's pretty important, whether you do it by actively managed fund, whether you do it by ETFs. Important thing is to maintain the balance right. Discipline, yes. So review regularly. You need to actually rebalance it because that will decide how much of a hit you take when the ensuing fall comes, which keeps on happening. Manish,
So you need to do you need to do the other as well. If the 20% goes to 15%, right? At the end of when you are reviewing at a certain period, you need to rebalance it back to 20% by selling whatever has worked out at that point, right? So this is called rebalancing. It doesn't need any, it needs a lot of behavior and very little skill. But all you are doing is whatever has worked, shaving it off to buy what has not worked. In a way, going contrarian, right? But do it on a periodic basis with discipline. Rebalancing itself, adds to the return. So correct. You can't just buy and forget.
Sure. One piece. Again, we are going back to real estate here. My portfolio today is heavy on real estate. In fact, it's around 85% on real estate. And this is consisting of commercial as well as residential properties. How do I move about getting to my goals?
Yeah, so 85% is a fair bit of an allocation into real estate.
All the allocation you have.
That's pretty much all you have. And I mean, one good thing, I mean, there is some cash flow from commercials, but still it's fairly chunky. Now, it's okay to have real estate, can be 10-15%, again, what I called are the four. These are not theoretical four, you can be move around it, but 85% is fairly chunky. Again, the idea would be, again, I'll go back to the basics, as I said, right? You plan your goals. The goals will tell you, when whether they are short-term goals or long-term goals. Short-term goals, you need to protect from market risk. And real estate, when we talk about, because the market is not ready nor efficient, right? You need to start liquidating real estate, because it won't be that you need money next month and you will get the price that you want, right? So you need to be judiciously start dialing it down and ensure the short-term goals are into something which is more into more liquid market. But even the long term needs to be optimized for the return. So second bit is to essentially do the allocation, and that has to be aligned to both the risk and the goals that are on the way. And the third bit is diversification. You can have a real estate pie into this. For this gentleman specifically, given that they have 85%, they might want to keep some, but that can't be a dominant allocation within the portfolio, because you can't really rebalance real estate, right? So when you have an equity and gold, and equity has run up and gold has not, you can rebalance by selling whatever has worked really well into this. But in real estate, you can't buy one market and buy it elsewhere because the market is not there. And even the transaction cost, buying and selling, is pretty much. So a lot of limitations by having a real estate dominant portfolio. My advice here will be, again, to start with the goals, do that plan for short term, long term, and so on, and gradually with an intent, with a plan, liquidate the pieces that are not either efficient or not working well, and then diversify into multiple asset classes. But diversification is the central thesis here. We have to diversify. It's a fair bit of a concentration on a single asset class.
Agree. So the idea here should be to move from low liquid to high liquid, wherever we are today. I mean, we are
Yes,
where
exactly.
we are. So if it is 85% today, it is. But the idea should be that you move more towards high liquid, because at the end of the day, what you and I will need is lump sum for our long-term goals and a series of cash flow for our retirement.
Yeah.
Manish, I think one final question I have here, unless few more comes in.
Yeah.
And this is regarding that we have multiple investment vehicles available. PMSs, mutual funds, stock portfolio, small case, AIF. Now we have SIFs coming. Is there any real differentiation all of these offer, or is it just different names for a similar approach?
Right. So good question, actually very good question. So we have various avenues or ways, products, services to so let me go back to asset allocation, right? What does asset allocation tell us? Asset allocation tells us that you need to have allocation to instruments within a specific asset class, right? It can be a stock, it can be an ETF, it can be a bond, it can be a deposit or whatever, right? So the idea is at an overall level, when I look at Manish's overall investment, this is how the allocation should look like, right? That's the central idea. And the allocation has to be based on my goals, my risk, right? The two pieces we talked about. So arriving at an allocation is a very distinct piece altogether. It has to be really personalized and it has to be done independent of what are you going to invest with, right? Once you arrive at the allocation, the next step essentially is to actually make it happen, right? And how do you make it happen? You go on and you invest in the instruments, which gives you exposure to the respective asset class so that you have that allocation, right? When we talk about mutual funds, SIF, anything that is structured, right? They don't do asset allocation. They give you exposure or, they invest your funds into the specific instrument allocation or an asset class through that instrument. So when you talk about a fund or a mutual fund or a structured product, that's what they do. When you talk about PMS can actually help you do this because you can buy multiple asset classes if there is a PMS wrapper available. Another way to look at this, if you consciously create a portfolio, you have to pick up various funds. So for a gold, you have to pick up an ETF or a fund of fund. For global, you have to again pick an instrument, but you have to assemble these various instruments, which enables you to invest into the respective asset classes. So creating this bundle or a pool is what helps solve this problem using the products that you just mentioned. Now, when we do it at Marcellus, we use a PMS and it's an actively managed PMS. So Krishnan and the team, he does the research, identifies the funds, the cheapest funds available, direct in all direct code, all in DMAT. They all go into a DMAT, the way we run our other PMSs. And what he does, he goes on to buy these mutual funds. And none of this has Marcellus product, by the way. All of these are mutual funds readily available in the market, but they are direct. So he does a fund selection based on this and basis the asset allocation of the investor, we go on to buy these mutual funds or ETFs or securities to create this asset allocation. And then we actively manage it. We do the whole rebalancing as and when it's needed, right? So we do it within the PMS, and it can be done in other wrappers as well, so long as we bring everything together. But the big difference is a mutual fund will not is a one size fit all, and also again very focused on a specific sector that you're buying. To create an overall asset allocation, you will have to tap into various instruments to be able to assemble this. And I think that's the answer to the question, whether how is this different from, or how the overall asset allocation is different from a specific instrument.
Sure. While we are overshooting time, just one last question here. It's an interesting one. This is about how let's say the young generation here in India or Gen Z is perceived. Uh, it is assumed that they have a mindset of instant gratification and everything. Maybe the success of Zapdos and Zomatos is part of it. Uh, when it comes to investing, how do we instill a long-term investing thought process or a discipline investing via mutual funds or via any chosen vehicle? What are the initial steps we should take? I think this question is from an MFT, so they are mentioning what step they should take as an MFT. What's your suggestion?
Yeah, so for someone who is young and maybe starting into the real world, if I think that's the question of how should they think about this, right? I think that's where the role of the trusted advisor comes in really handy, right? Because a lot of it is, as we saw, it's a time value for money, right? Time is one factor, and it's one dominant factor. An early start, I think one of the gentlemen who started SIPs at 30, right? Fantastic use case, right? So time, when you are young, time is by your side, right? Consistency and compounding can take you home really well, right? So I think again, for them, the advice will be no different than what we're talking about here. In fact, this is coincidentally in this slide, I've got the instant gratification as well, right? But the advice I'll give is start as soon as you start earning money. Be disciplined about savings. Ensure part of your funds go into savings. You save some of your funds and then channel them into investments. So there's a difference between saving and investing. So they should do that. Avoid debt for instant gratification. I think we all want instant gratification, but it shouldn't come at a rate. If you can delay the gratification, right? Again, the compounding helps you, get a better value of what you are going to pay today, right? And these are the two big ones. If you can delay the gratification and you leverage the time from the time value of money compounding bit, those are the two really critical ones to start with. Start early, remain disciplined, and leverage compounding. This comes at a principle, but again, there is no age for planning your goals, right? There's no age to figure out what I'm going to do when. And for someone who's just starting out, the sooner they identify this, the sooner they have controls on the direction, right? Think of it like this: if you put on your GPS map halfway your journey, it's suboptimal, because had you put on your GPS way before, you would have avoided some traffic jams, some potholes, road closures, whatnot. So the sooner you plan your destination, the sooner you plan the route, which is your asset allocation, and the sooner you remain in discipline following the plan and not sway left, right, center, the more likely you are to get to your destination in time. And
Yeah, key part here also, I think, is whether you are doing it yourself on your own, or you are doing it with the help of a professional financial planner. Be true to yourself when you're doing it, because that's what will decide how long this will go. I remember we were having this discussion with a young couple based out of Spain, and we were stuck on a few things regarding goals. And one partner immediately pointed out, no, you are very instant result chahiye wala person. You will not be able to do this. So at times that also helps, that you are balancing each other out. If there are, let's say, maybe do it with your partner, do it with your family. That ways you all are committed to it. But yeah, this is more behavior than as I think Manish pointed out earlier. That one part is simple numbers, time value of money. You will find n number of calculators out there. But what definitely is needed is a hand holding, control on behavior. And that part. Manish, any closing comments? We are done with the questions here.
Yeah. No, I think thank you everyone for your time today and for asking very, very meaty, insightful questions. It was a pleasure, sort of share this with you. Thank you. And again, do visit on the website if you would like to go deeper into the wealth survey insights.
Thanks, Manish. Thanks everyone for joining in.
Thank you. Good evening.